This is episode 36 of EO Radio Show. This week, I'm delighted to cover a niche topic and a special structure that allows certain nonprofits to have an outsized impact on improving their communities. That's new markets tax credit deals. These deal structures take advantage of a special tax credit for U.S. taxpayers that invest in the enterprise. Here to talk us through the why, the when, and how of using these tax credits is my partner, Julie Treppa. Julie is particularly experienced in developing strategies to help investors, developers, businesses, and nonprofit organizations to use tax incentives and tax credits to achieve financial goals while supporting social and other community-based priorities. Listen in. Welcome to the EO Radio Show, your nonprofit legal resource. Brought to you by the Exempt Organizations Group at Farella, Braun & Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. My guest today is my partner and my friend, Julie Treppa. Julie is a highly experienced tax lawyer with expertise in a broad range of tax-related issues and tax controversy work involving federal, state, and local tax laws. She began her tax career as an IRS auditor in the exam division. She has for many years advised clients on an exceptionally broad range of tax-related subjects, including transaction planning, investment fund formation, equity incentive programs, and more than a few nonprofit formation, tax exemption applications, and many other tax issues and nuances that arise during the life cycle of a nonprofit. Hi, Julie. I've been looking forward to this topic for quite a while, and I'm so glad you could make time for it today.
Thank you, Cynthia. It's great to be here.
So how did you get to this kind of a specialized tax area? While your tax expertise is very broad, specializing in these tax credit deals seems pretty narrow. How did you zero in on that?
To be honest, I was a senior associate at a law firm, and a client called asking who our expert was in new markets tax credits. The code had just been enacted, and there was no one in the office that could call themselves an expert. So the partner I worked for looked at me and said, "You are now our expert at new markets tax credits. Go read up on it and get back to this client."
Oh, that's a good way to get into it. The new laws do often newly specialized lawyers an opportunity to really shine. But you must have really enjoyed it and developed. I mean, why else would you have developed such a great expertise?
I did really enjoy it. I saw this as an opportunity to use my skills as a lawyer to really make a difference and work on projects that really would change low-income communities.
So tell us some examples. I don't know if there's a typical new market tax credit deal, but if there is such a thing as a typical one, what do they look like?
I wouldn't say there's a typical project. There is a typical structure. So there's various players involved in a new market tax credit financing. Basically, a tax credit investor gets a 39% credit over 5 years by investing in a community development entity. Community development entities are organizations that could be for-profit or nonprofit. They're certified by the CDFI fund, which is a part of the Department of the Treasury, and their primary mission must be to serve or provide investment capital to low-income communities or low-income persons. So these community development entities, or CDEs as we call them, compete to get an allocation of these credits from the CDFI fund. It's not like other tax credit deals where really just by virtue of making the investment, you get the credit. You have to invest in a CDE that's been allocated new markets tax credits.
There's a limited amount of this available each year or each cycle.
It's very competitive. And then those CDEs turn around and take the invested dollars and find projects that are compliant with the program. So they are typically projects that are in low-income communities, and they can be any active trade or business in a low-income communities. So it could be a grocery store. It could be During COVID, we used New Markets tax credits to finance a tissue factory to overcome the great toilet paper
the shortages.
yeah. But
such a distant memory, but it was so important at the time.
It was. But mainly what you see these credits used for often is nonprofit facility financing. So you have a nonprofit that has raised a certain amount of money through a capital campaign, but they don't have all of the money they need to complete the project. So they partner with a CDE to complete their project utilizing New Markets tax credits. And we use, and like I said, the projects vary, but the structure is typically the same. The tax credit investor, if they just put money into the CDE, would get this credit of 39%. That's not that rich for them. So what happens instead is they put their money into an investment fund, and then the nonprofit lends the money they've raised in their capital campaign to this investment fund. And the investment fund makes the investment into the community development entity. So the tax credit dollars are usually about 20% of the entire amount that gets invested in the community development entity. But the tax credit is tied to both the loaned funds and invested funds that the investment fund invests in the CDE. And because of that, at the end of the day, the tax credit investor is willing to walk away from their investment and just have the benefit of the tax credits that they got out of the deal.
So, Julie, let's think about putting numbers on this. If we have a $10 million budget for our project, let's say it's a toilet paper factory, we've got a tax credit investor willing to put in $2 million, and the nonprofit has $8 million. So the tax credit investor then gets how much of a tax credit against their other taxable income in that example? They get the full.
They'd be the sole owner of an investment fund that invested $10 million in a community development entity. So they'd get tax credits equal to $3.9 million. They only invested $2 million. They are willing to walk away from that $2 million in exchange for that $3.9 million tax credit.
And then at the end of the day, the community organization owns the building.
What happens is somewhat complicated. The community development entity takes that money and loans it to this qualified business. After 7 years, the tax credit investor puts their interest in the investment fund to an affiliate of the nonprofit. So then the nonprofit owns the investment fund that owns the CDE that lent the money to the qualified business.
Got it. Okay. So at the end of the day, you've got your nice building. It got built. The nonprofit didn't have enough money to build it in the first place. A magnanimous investor closed the gap with the financing. And with the benefit of the federal tax credit, it works out beautifully for the benefit of the low-income community.
Right. And the nonprofit, in this case, would get $2 million less whatever fees it had to pay in this transaction, and has their building and doesn't owe anyone anything.
Anything, right. Okay, so that's pretty cool when it works.
It works.
And it works. It does work. So, and your threshold is finding that you have to get an allocation of the credits, which sounds like a pretty tough part of the deal.
That is. And you, the nonprofit, doesn't have to get that allocation of credits. The community development entities have to get it. And so what they are out there doing is looking for the best projects they can find. So when they submit their application to the CDFI fund, they can either make the argument that, look, we've done these great projects that have changed these low-income communities, or we have these great projects in our pipeline that we are going to do if you give us the allocation of New Markets tax credits.
Got it. Okay, that makes sense. So what types of fees and expenses does a deal like this generate? Sounds like it might be kind of expensive.
They can really range. So it is a competitive process for the community development entities. And so they often charge an upfront allocation fee in exchange for using their allocation. And that can really range. Some don't charge a fee at all. Some charge a fee equal to 2 or 3% of the equity investment that's made in their entity. If they often, to make their application more competitive, the community development entity may say, we're not charging any fees, but that doesn't mean there's no fees in the back end. At the end of the day, they're also a lender. So just like any loan, they might charge loan servicing fees or other fees that are commonly associated with a loan transaction. In addition, it is a quite complex model and everyone has to be very comfortable with it. And the project pays everyone's attorney's fees. So there's legal fees paid to the Tax Credit Investors Council, the CDE's council, as well as the project's own counsel. And that can range $200,000 to $300,000. As a result, you don't usually see a new markets tax credit project that's less than $10 million. In order for it to be worthwhile, there has to be a large benefit that you're realizing from a tax credit investor.
I know there's a lot of different questions here, but one of them top of mind for me is, what's a low income community? How do I know or the community where I'm going to do my project, this will work in my community?
It's simpler than it sounds because it's all based on census tract, and that is public data that you can research. There's maps online. The CDFI fund has a map that you can utilize where you input the address and it'll tell you whether you're in a qualified census tract or not. The census tract that are low income have at least a 20% poverty rate, or the median family income has to be below 80% of the area median family income. But that alone, that makes you eligible, but that doesn't make your project all that desirable for a CDE that's out there trying to find the projects that would have the biggest impact so that they can put that on their application. They're often looking for higher distressed low-income communities. And those are census tracts with a poverty rate greater than 30% or a median family income that doesn't exceed 60% of the statewide median income.
So as a nonprofit, I have my $10 million project. I think I'm in one of these areas. How do I make my project attractive then? Do you work with consultants, work with lawyers to try to make your project fit within some CDE's target? How do you go about getting into the mix for pursuing a new market tax credit deal?
Well, I think I would first look at whether you're in a high distress community or not, and then think about other factors that you have to your benefit where this project's going to help the community. How many jobs is this project going to create? Both temporary, perhaps construction jobs and permanent jobs. How are the residents of that low-income community going to be served? Is this a health center that's going to benefit residents of that low-income community? Are you going to be providing some type of services that are really necessary? All types of ways that you can think of that this would benefit the community. And then typically you would go speak with a consultant that may help you think of factors you haven't thought about before, but also help introduce you to the various community development entities that are out there that have available allocation. That said, I have one client who herself just went on this CDFI fund. You can look at who has allocation and you can look at who has allocation that they haven't used. It's all available on that website. And she had a very unique project and she reached out herself to various community development entities and then found one that was interested in her project. And they, in fact, helped her find other CDEs to fund the project.
Oh, neat. So it's kind of like any other nonprofit fundraising. You develop your pitch deck and say, this is why you should fund me, and start dialing for connections and dollars.
Exactly. And then lawyers, we come in more to make sure the project's legally compliant. We also have our own contacts with CDEs and tax credit investors. But personally, I think the consultants are better at getting out there and selling the projects. That's not really what I'm paid to do.
I think that's a good segue to another line of questions, which is, what are the risks in this kind of a deal? I mean, aside from it seeming very complicated, how do these things go sideways?
So at first, it sounds very scary because the tax credit investor wants their tax credit. They're investing $2 million. They want their $3.9 million of tax credits. So if your project, upfront, you'll have tons of lawyers looking to make sure you qualify as a qualified active low-income community business and you meet all these various requirements. But after that, you have to stay compliant. And if you don't, you have to indemnify the tax credit investor if the credits are lost or recaptured. And that indemnification will be not only on the tax credits itself, but any penalties and interest the IRS may charge, etc. That said, there has never been a recapture of a new markets tax credit transaction.
That's good to know.
You can't tell people, oh, there's no way this will ever be recaptured. But I think there is some comfort in the fact that the people that are working on these projects work very hard to make sure that you are originally compliant and that practices and procedures are in place to remain compliant, because they know a nonprofit that isn't familiar with this program has never used it before, might not be familiar with some of the more obscure tests like the non-qualified financial property test that could harm you if you hold too much cash. Holding too much cash in most nonprofits' world is not a problem.
Not usually a problem, yeah. What else is important for the person new to this kind of structure? What other questions should they ask, either themselves or their consultant, when they're thinking about going down this route?
I think you want to understand what you're going to have your consultant do versus what you can do yourself. Because again, the benefit to the nonprofit is what the tax credit investor puts in, less your fees and expenses. So you want to try to minimize your fees. What do you need that consultant to do? If you're going to develop, substantially rehabilitate a building, you might need a consultant that's going to help you get permits, negotiate a construction contract. But maybe you've done this before. Maybe you're a nonprofit that itself is out there. I have one client that often buys buildings and rehabilitates them for arts organizations. They don't necessarily need a consultant to come in and take over that part of the project. They can do that themselves. So I think first you got to think, what do I need to hire someone to do? What can I do myself? Then legal fees can really get expensive in these types of transactions. How can I work with my counsel before other counsel is coming into play to really get my project? So on, all four sides of a square looks and smells like the right type of project that's going to meet all of these compliance requirements, so that you don't spend a lot of time where, counsel for three different parties are discussing this, because that just gets expensive.
So Julie, are there red flags that you see where the fees and expenses start to get out of hand? When do things really start to go sideways on the legal expenses?
So often I see things get out of hand with respect to the other sources of income that are coming into this transaction. So like I said, in order to leverage off those other sources, the money goes into an investment fund. The investment fund makes an equity investment in a community development entity that loans it to the project. So you might have received a particular grant that you want to use for this project. We really need to make sure that grant allows the income to flow in that way. Often you'll see a grant would require that the money goes directly into the project. So we might have to go back and discuss that with whoever made the grant, and that might be a state agency. I definitely have had to appeal to state agencies and convince them the money really is going to end up where you think it, where you're intending it to end up. It's not going to go into this investment fund and be used for other purposes.
So it seems like there's a little bit of back and forth, but you wouldn't want to have your whole plan for your project laid out and raise most of the money and then say, oh, we'll just close the gap with a tax credit deal. That's not really going to work. It's more of, we have this great idea, might be eligible. Let's check it out. If it is eligible, where are we going to get other money? And then you kind of pull the whole package together simultaneously rather than going down one path and then switching gears to a new markets tax credit deal.
Correct. And you can be reimbursed through a new market tax credit financing for expenses you incur in the interim, as long as they were incurred and paid within the last 2 years. So, for example, if you want to buy a building that you're planning on rehabilitating and using for a nonprofit facility, you might be able to be reimbursed for the purchase price of that building if you bought it within the last 2 years. You can't start the project with new markets tax credits in mind and eventually get reimbursed for those costs that occurred before the financing.
So it sounds really complicated overall. Where can listeners go for more information? How does somebody new to new market tax credit deals from the nonprofit perspective, where do they best start educating themselves aside from this particular episode? Do you have any resources that you would recommend?
You definitely can go to the CDFI Fund website. They do have a New Markets Tax Credit tab. They do often put together programs to educate people on how the program works. And community development entities are out there also trying to educate people on how they might be able to utilize these credits.
So we'll put those links in the show notes.
And then if you think you're interested and want to take a deeper dive into the credits and how they work and who the players are, there's various conferences that are offered where, they're 1 or 2 days, but they often have an introductory session that you can go to that will explain the basics of the credits. So Resnick and Novogradac are 2 accounting firms that put these conferences on. And then, like I said, various community development entities are often putting on conferences to educate people on how the credits work.
Oh, that's great. So we'll put links in the show notes to some of these. Anything else top of mind, Julie, that you think our listeners would be interested to hear about the new market tax credits?
I just think we stressed this at the beginning, but it can't be stressed enough that there are a lot of different types of projects that are going to qualify for this credit. So it's called a qualified active low-income community business. But in the nonprofit sphere, you don't have to be actively engaged in a trade or business. You have to be engaged in an activity that furthers your mission. I've done projects that range from something you would think might be eligible for this credit, like a health center, a rehabilitation center, something that you wouldn't normally think should get tax credits, like a tissue factory. And one of my favorites was the use of this credit for environmental purposes. So it was to preserve a salmon sanctuary that was important to this particular Indian tribe. And so they were able to use this to create a forest plan to create space so that this salmon sanctuary wouldn't be disturbed.
Oh, wow. That's cool. So lots of different possibilities for nonprofits to really use this remarkable leverage for the tax credits for their community's benefit. So I think that just about wraps it up for this episode. For listeners that want more of an education about new market tax credits, check out the show notes for links to more resources, to Julie's bio and her publications, and we'll put as much stuff up there as we can. So with that, I want to thank you, Julie. It's been so much fun talking to you about this. I feel like I asked some pretty inane questions, but thanks for your patience in filling us all in.
Oh, thanks, Cynthia. It was really fun.
I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella, Braun & Martel. If you have suggestions for topics you would like for us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us. Until next time, make a difference.